Boy, if you would have guessed based on the market reaction what the Fed did today and what their bias was going forward, you really wouldn't know. I mean, we had quite the day, bullish day heading into it, a knee-jerk reaction up and down afterwards before closing at the low of the day, but still closing around support levels. The bulls were there today. The bulls were there and ready to take the ball away from the bears, but the bears made one last charge, and we'll see going forward, and I'll break down the technicals to see if the bears are going to be able to push through the line and make their way to the end zone, or are we going to this near-term battle we've been having, is it going to resolve itself to a new higher low point on the broad market? And so I'll break all that down, as well as a new leader, a sector leader, for what could be a bullish move in the markets based on today's price action. So interesting new leadership, and we'll take advantage of that with our trade idea. So let's go ahead and get started. Today is Wednesday, March the 21st, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that are watching us for the first time. Glad to have you. Keep coming back for more. Subscribe to our YouTube channel by clicking that red subscribe button right down below the video. You can do that right now while you're watching. Also, while you're down there, click the thumbs up icon. That lets me know that you want me to do the video again tomorrow. It also lets me know that you found something useful out of today's video. One click, very easy way. Again, you can do that while you're watching. Easy way to give us some feedback there. Comment on anything that stands out to you. If you're watching this on the YouTube channel, you can scroll down to the bottom. Same thing if you're watching this on our Market Scholars blog. Scroll down to the bottom of this blog post and you can comment down there as well. Join our daily email list so you can get up to date on everything that we're doing at Market Scholars, as well as when these videos are finished and posted. There's a description. There's a link I highlighted in the description below on YouTube. You can also do the same thing on our blog. In the top right corner of the screen, there's a link that says subscribe. Click on that, follow the instructions there, and you can get on our email list the same way, while at the same time subscribing to our website. Follow me on Twitter for more content throughout the day. You can see my handle on the screen at DavidSettle42. Like and retweet today's Market Outlook tweet, always pinned to the top of my timeline. Finally, join our community. Join the Market Outlook community. You can do that on Facebook. You see the address of the screen at the top there. There's also a link that I've highlighted in the description below that will take you there as well. All right, let's go ahead and start off taking a look at the S&P 500 with the market forecast indicator. So we actually were doing pretty well right immediately after that FOMC announcement. Then we came back down and closed at the low of the day, which means an extreme low on the momentum line. Now, we were already pointed slightly lower anyway, so we have this bearish posture on the market forecast indicator, weak bearish, and you can see, again, you have a long lower shadow from Monday, and then today you could argue that that is a inverted hammer pattern at the bottom of a downward move. So that can be a bullish sign. And you can see the bulls were strong enough today to get up to Monday's high point before falling, and by the end of the day getting close. In fact, right at the end of the day, we made another run up to those highs and then fell the close. You can see near-term lines rising slightly. So now we are let's see, 1, 2, 3, 4, 5, 6 days under 50. Not the best near-term setup there for a bullish trend. We don't like it to get in the reversal zone, but we also don't like it to stay this far down. So kind of giving us it's a little bit of a warning sign, we're still forming a higher low point and still in the Fibonacci retracement area here of 38 to 62% Fibonacci retracement. So we haven't really broken out of that area yet. And you can see that green one comes from the last intermediate run that we had. So there's the last intermediate run. We pull back, and we're kind of still easily up above the 38% Fibonacci retracement, above that Fibonacci zone from this bullish move. So it's hard to be too bearish, and that's why it's just barely going down. But short-term sentiment is not improving yet, and so that's while you expected this 38% and this 2750 to hold until it didn't, and it didn't on Monday, but then we couldn't continue the bearishness from Monday, and that long lower shadow, the low of that day, right around 2700 is going to act as a support level. Now it breaks 2700, we'll be a lot more bearish here for a while. Hold 2700 and bounce off a new higher low point. and then things can change back to being bullish. Now, are we going to bounce up to new highs in the next near-term run? Maybe not, because of how deep and how long the short-term run has been. We didn't bounce off of here, but it doesn't mean that we have to be extremely bearish either. In fact, it kind of gives you an idea that we might be having some ups and downs here, like we have been really since the beginning of February in this area, in the upper half of this area, and with the worst case it being in the lower half of that 4-week range that you'll see here in a second. Now we look at the Dow Jones Industrial Average, which looks very similar to the S&P. Again, long upper shadow in this case, but an inverted hammer because we're at the bottom of a downward move. So it's not as bullish as a long lower shadow. Same thing on the upside. On the upside, long upper shadows are more bearish when you're at the end of an upward move. So here we're getting a long upper shadow at the end of a downward move. So it's bullish, but not as bullish as long lower shadows are. Those tend to be more bullish. But regardless, you can see the intermediate line again fluctuating around that 50th percentile, has been, until it breaks out one way or the other. And you could say that it kind of broke out. Well, it did break out of this little trend line, but in reality, we haven't broken below that 2450 level either. So we're still kind of mired as well in this Fibonacci muck area at that 38% Fibonacci, 38 to 62%. Of course, the Nasdaq Composite barely now showing a weak bearish posture for the first time, despite improving short-term sentiment. Its momentum line did not drop to an extreme low. It's still around the 50% retracement level of this. Not as bullish, not as bearish either as the S&P and the Dow are, because again the intermediate line is just barely below 80, and the Russell 2000's intermediate line did not get below 80. In fact, it had a really good bullish day today. Not nearly the same length of the long upper shadow, holding the 38% Fibonacci as well as that old high point, in this case at 1560, but more 1550 is the stronger area. So in short-term sentiments, come back up after one day being above it here on Monday. We got one day below it yesterday, and now right back up above it again, and moving up higher again. So small cap showing a more bullish picture on the market forecast in the S&P 500, which again, now we are bearish in the S&P, but this is another sign that we're not as bearish. It's a weak bearish posture, and of course on the Nasdaq, it's the weakest bearish posture it can be. It's it's kind of backed up against its own, the bears are backed up against their own end zone, so to speak, if you want to use the football field analogy on the market forecast chart. All right, so the long-term chart, you can see, this should put a lot in perspective of how bearish we've been in the last so many days. It's been a little two-week pullback after getting up to above 2,800 on the S&P. But you see how far, we're still, easily above the lows of the past couple of weeks. See how the lows have been all rising, except for this one here, and then really except for that one. You see how, other than these two small ranges that were in the top of those weeks' trading ranges, and both those were bullish weeks coming off of sharp low points, long lower shadows. Every other time you can see the lows are getting higher and higher and higher as of right now. Of course, we got 2 more days left this week, so the lows can continue to push lower. But there's still a wide gap between 50. If right now this would still be the biggest gap that we've had on the absolute basis between the 50 and the 200-day moving averages previously. So decent move we have going on here. And as that MACD continues to fall and grind lower, you're going to get more up and down arrows. And we've seen the last 2 times we've gotten red arrows, we've bounced right back up off of them with a pretty strong weekly move the next week. We'll take a look at the 3 green arrow chart here, and we're back to 3 red arrows again with a small close below a flattening moving average, still trading around that. And the 8's now below the 17, just barely. You can barely see the MACD getting below 0 here, and just a little bit below its moving average. Stochastic's also below its moving average. So there's some weakness, but not enough. We could turn right back up, and that would still be a good bullish move with potential for bullish momentum to the upside. And then Stochastics can form another phantom green arrow again like it did before, if this little area of support were still to hold. And yeah, we've broken through this little trend line here, but you can still see there's multiple areas of support here that are still holding it up. Break through this 2,700, different story. A different story at that point. But again, expect support to hold until it doesn't. Is always how you look at things. All right, really quickly, I wanted to interject here. If you're watching this video from the blog, which some of you or a lot of you may be doing, because that's the links to the from Twitter and from the email list and from Facebook point you here. If you're watching this video from the blog, remember right below the video is the embedded tweet for tonight, as well as the Facebook post for tonight. So you can like those two things while you're watching right now just by clicking on the heart right there and on the thumbs up right there. When you do that, a little pop-up window will come up just like that, and you just confirm that like just like that. And the same thing will happen with the Twitter. A little pop-up window will pop up, and you hit like, and that will add you to that total. This is a retweet. Some of it might actually tell you to see other tweets of mine there. But while you're watching right now, just click on those two things, because again, that tells me number one, that you want me to do it again. It also tells Twitter and Facebook that you want them to keep showing you my stuff because you're engaging with it. And what it helps me out with is it tells Twitter and Facebook also that this is good, engaging material that they should push out to everybody who follows me on those two platforms, because that's not the case. They don't always push this out to everybody. And so that's how I can benefit from that. So I appreciate that. And let's move on now to the intraday chart here. And you can see we did, before the announcement, we did come up and got up to higher highs, still a small range, but then we got all the way up to last week's low point and basically the gap before falling back down to today's low point. So almost a 3-point move intraday here, down to today's low point. Well, actually was a 3-point move. Right immediately after the FOMC announcement, before closing at the high of yesterday's high, and then kind of in the middle of today's range. So you notice we didn't like break through the new lows here. And remember, I always like to look at that 4-week range to kind of see where we're at, and we're flirting right in smack dab in the middle of that 4-week range. You can see, 263 to 279, and about 271.5 is the middle. So if we get above that and get above these highs and stay up here, great. We're back to being bullish again. We're bouncing off a low point. We break through 270, 269, not so good, right? That's when we know, we might not break 264 anytime soon, but we're going to be, the market's going to be heavy and be in this lower half, and that's going to put some pressure. Again, remember, typically we don't break the low point and keep pushing it until it's tightened up a little bit. And right now it's not tightened up at all. So we'd want to see it tighten up to that low point, potentially as we get back up to around these highs, tighten back up to there, and then maybe even tighten up even more if this ends up being the low point from there on. So we like to see that. Typically it tightens up to about, to a good few points, 4, 5, 6, 7 points. That's when you start worrying about a breakdown to the downside that's more extended. Let's take a look at the daily, at the total range of the day. And the volume you can see, again, below average. So very, very little volume, and a trading range at 3 points. So 3 points is below the average. As high as it is, it's below the average where we're at right now. And of course, the volume keeps coming down too. So the more these keep coming down, the more bullish that is. It's when we start getting 150,000 shares traded, that 1.5 times. We get a few days in a row of that. We get 4-point plus ranges. Then we're bearish. Then we're going to be bearish for a while as we start pulling that back up to the 52-week highs. So that's the issue. That's what we're watching. The fact that both of today's results were below average, not very much below average. We're not strongly bullish, but below average enough not to be really strongly bearish either. And then finally, look at the volatility chart, potentially coming off a higher low point. So we'll see if that ends up being the low where we form right now, because again, we don't really have a whole lot of room to go down the VIX. This is about where it gets to, generally speaking, before making another run like we've seen in the past, right? So we got down to 15. We made and we've spent some time here around 15. So the last time we got up to 40, we came down to 15, spent some time around there, and this is, these are a lot of days here. You can see we spent a lot of time around that 15 to 17 area, about a couple of months before making another run up to the high 20s and 30s. So definitely could spend a couple of months here going, which would be, from the end of February through the end of April, before making a potential another run up to the high 20s, low 30s in May and June. So when I said before that volatility could return in the spring, that's kind of what I was looking at this area as the spring, because I live in Utah, and right now, and then for a lot of you on the East Coast, sure not looking like spring out there right now. So Utah, like our spring lasts a few weeks in May and June before it gets really hot again. On a relative basis, the volatility still, kind of upper, it spent most of the day in the neutral area from low to high. It actually got down into the bullish zone below 90 before finishing at 95, which is still the top end of the neutral area. So again, not strong enough to be good, strongly bullish, but also not above 1 either, which would tell you to be bearish. So you can see how it continues to grind lower back into this bullish zone. All right, now as we transition to what's driving this price action, of course, the big news today was the FOMC meeting and the rate hike that we got and the forecast that we got for future rate hikes. GDP, projections for inflation, GDP, unemployment, the Fed funds rate. You can see the projections for there, which are always wrong, but, we got to get an idea of what they're thinking today with these projections. What that did to the market, the market here, so this is December. Here's the odds. This is where we're at right now, the 150, the 175. So if I were to go to the current rate here, you can see we're at the 150, 175. So we're looking to see if there's going to be a June, September, December rate hike. And there's right now about 34% odds that we're going to get one. Up a little bit, but not very much from what we saw today. If I were to now take a look at the charts of that. So there's the odds of, let's see, go back, sorry. Whoops, not there. Go back to the current here. So there's the odds. 150, 175 is where we're currently at, and it's shaded there. You don't see it shaded here, unfortunately. So you just have to remember that that's the current mark. The purple one's the current mark. So having 3 by the end of December is this dark blue one, and it's pretty high, but not as high as having only 2 more. And that's still holding steady as the highest rate at 40%. And of course, only having 1 is not very far below having 3. So the market's not really too hawkish or dovish right now. We take a look at September, where we're supposed to get the second one. All right, so 150, 175 is the current. There's the purple. So we're expected to get at least 1, if not 2, by September. But you notice, so the having 2 is the highest odds, but there's not much gap between those either. So it's still a question mark as to whether we're just going to get 1 or 2. Of course, the odds now that we're going to get 1 by June have really continued to take off, and there's the odds of not getting 1 at all, so below 20%. So we have above 80% odds now that we're going to get that rate hike in June. So June's okay. Market's pricing that in. But for September and especially for December, it's kind of 50-50 whether or not we're going to get 4 by the end of the year. So the market really didn't come out of today too hawkish or too dovish. There was other things like the federal, let's see, the existing home sales came out today as well. It wasn't very, had some growth there, but it's not as high as it's been. Just a little bit of a rebound. You can see that mortgage rate really taking off. That's going to be a headwind for existing home sales. We take a look at the chart here. Here's the chart finally. When you look at what's really moving, look at that crude oil price taking off again. We take a look at the price of crude oil in the futures contract here. Let's go to the daily chart. Look at it breaking out. So we mentioned that breakout before, and now retesting these new highs. So nice strong move, continuing to show. Here's your dollar weakness. The dollar pulling back down, continuing to move lower from these highs. A little bit of a head and shoulders pattern developing as a continuation pattern, not necessarily as a reversal pattern. So that's impacting crude oil, and you can see crude oil just taking off. Emerging markets doing well too. Let's just take a look at just what happened here today. And you can see up 3% on that inventory and that really bullish inventory data. The dollar pushing lower, and that pushed gold up. Gold and metals doing well. You can see your risk asset classes Small caps really taking off versus large caps. Pull back at the end of the day, and pull, was bullish before the day started. And then you can see emerging markets also outpacing developed markets, with long-term bonds coming down, finishing day flat relative to high yield. So I mean, it was a risk-on day today. The only difference was that gold is so bullish, it outperformed stocks, but only did so because of that's some pretty strong weakness, 0.75%. That's some pretty strong weakness for the dollar, and a lot of that coming right before and especially after that FOMC meeting, where again, they didn't really come out of it too hawkish enough to start to raise those odds for a December rate hike, for that fourth 2018 December rate hike by December. It's still really kind of iffy for that. There's still decent odds for it, better than not than the third one, but they're right neck and neck with each other still. Now, when you take a look at remember, long-term bonds dropped. There's your yields making a run back up to above 2.9%. In fact, this is the highest close that we've had, for a week so far. Now, granted, the week's not over, but you can see it's making another run. Yields are on this, the FOMC meeting, around this FOMC meeting. Big time doji pattern at resistance usually is a reversal pattern when it's at resistance. That means there's a really good battle going on there. Also, again, get above 2.95%, you're bullish, right? It's kind of like a little bit of a flag pattern that you would expect this to be the breakout of, right? Something like this. Try to come down, try to fit this as best as possible. So you'd say a little bit of a flag pattern. You'd expect some bullishness to come out. But that doji, it would have been better to have a good, strong, bullish candle body. But the fact that we didn't have a body and we had a big range for the day is a little concerning as to whether or not we'll be able to hold this little flag breakout pattern and renew this bullish run on yields. And, if that ends up being the case, we see utilities and real estate continuing to be pressured to the downside, lagging behind the markets as the markets kind of caught up to it. Financials did okay, but pretty much matching the markets. But look at those weak dollar sectors, energy, materials. They love a weak dollar, and they will tend to outperform when we're in a bearish dollar environment. Those particular sectors have really been lagging for the last, especially energy here. There's materials. You can see it's been during this run, this bearish run, it's been dropping. And if I were to go a little bit further out, see there's from this month, and really let's go from right here, from this peak that the stock market had at the end of January. So during all this weakness here, you can see energy has been down the most, down 14%. It did really well, but it's been down the most. And then there's materials down 9%, and period, when the broad market as a whole is down about 5%. So really strong losses relative to the market, even though the market's down too, but much stronger losses. Consumer staples struggling too. But you can see technology with small losses, utilities bouncing up, real estate trying to bounce up. But look at that bounce up, boom, boom, this today on both of those. So if the dollar continues some weakness, those are the areas we expect to show some opportunity. So let's talk the energy sector really broke out a lot today. And I want to take a look at some of the stock, or at least one of the stocks in there for our trade idea of the day. Looking at ConocoPhillips, and you can see we did get 3 green arrows yesterday, right? The MACD's green, the Stochastics Phantom, and we got above the moving average. Not a lot of volume. Today we did get the volume. Look and see, you can see the average volume pushing up through a lot of highs here. And again, how bullish can we be when it's made that big of a move higher? We can't be too bullish. And you can see that we've done this before. We did it over here, peaked, and then came back down and retested. So, I don't necessarily want to buy stock because it's been really beaten up. We've got a trade idea on Halliburton from months ago. It's a long-term trade idea. We just want to ride that sucker for a while, and you can see a lot of those kinds of stocks have been bouncing. So how bullish we want to be? There's some obvious support at 52.5. There's some short-term resistance at 57.5 with some more longer term at 60. You get above that, and we've got some opportunity for an extended run. But we can say, okay, what if we were to sell right now. Put here right in that 30 to 40 delta range. Unfortunately, we don't have a 55.5. That would have been, you know, in that mid 30s in the delta. We don't have that opportunity. But if we sold the 56 and bought the 54, we're getting pretty decent credit. And you take a look at the Analyze tab, we got higher than 60% odds of success. And you throw that strike price on the chart here, and you can see, you know, this at those highs. I mean, it's also, you know, you break up above this upper Bollinger Band, you expect to push away from it and make this go up higher again, make the Bollinger Bandwidth start to move up higher. But if we break above that and push up higher, there's our break even. You can see our loss. No matter what day that group where that line intersects right there, it's going to be about $38 loss. We're trying to make 52, so we've got a little room to work with. If I want to get to a 1-to-1 reward to risk ratio, you know, that worst case scenario is about 55. If it were to get down to 55 and get back below this area, then there's a pretty good chance this breakout doesn't hold. And I mean, that's a pretty decent breakout. If it doesn't hold, then that's a pretty decent fake out, similar to what we had right there. This is a little different. We weren't getting above the upper Bollinger Band with a really low bandwidth like we are now. So that's what separates this kind of a move from that kind of a move where we had previously. Plus, we were coming off a volatile period, coming off of a low point that was outside the bands and kind of testing the middle moving average with that fake out breakout. And then here it's a bit more of a basing pattern that we're kind of breaking out with this coiling action. So there's an opportunity to take advantage of weakness in the dollar, strength in crude oil as it pushes higher, but not being too aggressively bullish because, you know, there's some resistance in these areas. All we don't need to go up too far. If I were buying the stock, I would. If I were buying a call option, I would. But as long as it stays above this breakout zone, then we're good, right? That's what we want. We'd be able to get a decent reward to risk ratio at a decent probability of success. So in summary, despite the breakdown we had on Monday morning, things appear to be kind of basing at some support in the broader markets for the last couple of days. Now we got the FOMC behind us with neither really a strong hawkish or dovish bent. And now we'll see if the technicals start to push up off of a higher near-term low point. Maybe not to a higher near-term high because of how long we've been bearish. We might fluctuate some ups and downs, especially with the Dow. We see the intermediate line fluctuating. But you can see, you know, there's some dominant themes in the market that could provide some leadership for a bullish run, for continuing this intermediate bullish run. And one of those themes is a weak dollar and those sectors that would benefit from that. Nice, good breakout in a lot of those energy stocks, with today's trade idea being among them. So, as always, thank you very much for watching. Really appreciate it. Remember to like, subscribe, and comment on our YouTube channel. If you're watching this in the blog, remember you can click on the YouTube logo to get to the YouTube channel itself. Love to see the thumbs up there, as well as remember the likes on Twitter and Facebook down below this embedded video, just to again let me know you want me to keep doing these videos day after day. One click, easy way to give us feedback there. Have a great one. Tomorrow Brandon will be back on with us. He'll be doing the video again, then I'll close up the week on Friday. So that being said, thank you. Have a great evening. We'll see you all tomorrow.